Welcome back traders, Philip here from BlackBull Markets. Hope you're doing well. In this video I want to talk to you guys about journaling and how I as a full-time trader use journaling in my strategy to improve my overall performance in the market and my return in my trading. So make sure to stick all the way through to the end of the video to see how I use this very handy tool and almost necessary tool in my trading strategy. Also make sure to smash that like button, guys. Subscribe to the channel if you're interested in learning more about trading and improving your current trading skills. So without further ado, let's jump into the whiteboard and see how we can improve this, or use rather a journal to improve our trading performance. Now, the one thing I want to take you guys through as well is a lot of people say, you know, you need to write down your emotions before you trade, or before you took the trade, you know, what you did before you took the trade, what you ate, your routine. Guys, it's not necessary. Journaling is extremely simple and very, very basic. There are some things you can add on, or, you know, if you really want to make it more in depth, like screenshots of the trades you took, which we'll cover in the video as well. I'll also talk to you guys about how we then use this data to our advantage. So the whole video, I'll take you guys through sort of what we need to write down in the journal and how we use that data to our advantage as well. Okay, so the first thing I want to do is we're going to write down our pair that we trade, right? So whatever pairs we trade. Now, when we trade, or when we start to do, let's say, a test, obviously you're going to start testing your strategy first before you obviously implement it into a live account, hopefully. Right, so this test will usually last between, I would say, 20 to 30 trades is usually a good thing to do. So you go through different pairs. Now, as a day trader, it's a little bit more difficult to do, or can take a little bit longer. The reason being, as a swing trader, you know, we've got a lot of time on our hands when we wait for the market to move, so we can trade multiple pairs at a time. But as a day trader, it's going to be a little bit difficult because you need to be really focused and zoned in onto that one pair and trading kind of the emotions and the psychology in that market. So it might take you a little bit longer to get 30 trades, or actually multiple pairs down the line. So what I would say is maybe look at maybe 2 or 3 pairs at a time when you do day trading, and you can kind of see which pairs works the best for you, and then cycle through those 30 trades. So, you know, pick a group of 3 trades or 3 pairs you want to trade those for, let's say, 20 to 30 trades. All right. Next one, choose another group, and then choose another group, and then, you know, you'll, in about 60 or 90 trades, you'll have about, you know, 9 pairs that you've looked at over that course of time, and then we can start using that data. All right. So first of all, like I said, write down that pair. Now, what this is going to help us to do is we're going to see which pairs make us the most profit, which pairs we break even on, and which pairs we obviously take losses on. And now what I do is, after I do this sort of test in my trading, I would say, okay, well, the pairs that make me the most money, I'm going to keep. All right, the pairs that I break even on, I'm going to get rid of, actually, because it's a lot of wasted time trading something that doesn't actually give you anything in return. Even if it's, you know, if it's a small profit but close to break even, just get rid of it, because it's not necessary in your trading. Ideally, you want pairs that give you a good return for that time, so you can keep those to waste less time and make the most amount of profit as possible. And then obviously we're going to remove pairs as well that make us no money and actually cause us to lose money. Okay, so that's pretty simple. Just remove those. Okay, the next one we want to do obviously is our, let's call it our entries or our signals. So let's call it, so our signals can be anything from, you know, a certain candlestick structure, depending if you're a day trader or a swing trader. If you're a swing trader, I'd say more, let's call it entries. Entries. Okay, we want to get entries down. So this is going to say, so what pattern am I trading, right? So for me, for example, as a swing trader, I'm looking at, you know, usually we have, you know, zones that we trade in. So I'm either looking for things like head and shoulders around these zones, or double tops around these zones, or any sort of technical pattern. So these will be the patterns that you chart down. Now it's going to be this is working very similar for you towards, like I said, with the pairs. Again, we're going to look at what patterns work best for us, what patterns make us break even, and also what patterns make us lose money. So we're going to go through that same process. Now, as a day trader, I know it's a little bit more difficult. Generally speaking, we don't have things like head and shoulders or double tops, right? So with day traders, generally speaking, we trade that little candle structures. So look at candle structures. So this is where you can kind of start looking at maybe doing screenshots instead, or even if you don't have a digital sort of digital journal, if you're writing it all down, just draw the pattern that you have. It might take a little bit longer, but just draw sort of the candlestick structure. So for example, if you see the market has made a nice big green candle to the upside, and you're just, you know, broke past resistance, for example, the next candle opens up and pushes back down, starts to reverse, and you take an entry over there with stop losses wherever, and the market continues to run, right? Because we're looking for that liquidity grab, the market pushes up, and that's sort of the trade you want to take. So just write it down, draw the little image in your journal, or if you, obviously, like I said, if you have a digital journal, something on Excel or something, which is very handy, just take a nice screenshot of it and put it in there as well. Okay. Now for swing traders specifically, the other one I would just do is not just our entries, not just our market structures that we're going to take, but also our candlestick confirmation. So I'm going to go just CC, write down for candlestick confirmations, right? So generally speaking, what this is, obviously, if let's say we created a head and shoulders, for example, right, and the market reaches this resistance, I'm not just going to take this sell over there because the market's reached a zone, because this can very well continue further higher and go all the way to the top. So rather, what I'm going to waiting for is I'm going to wait for a candlestick confirmation, where it would be anything within markets sort of telling me, okay, well, I'm ready to turn around here. Let's say the buying power is running out, okay, and the market gives me a bit of a signal to go to the downside. So signals that I generally use for candlestick confirmations can be anything along the lines of engulfing candles that I will take. So something along the lines that look like that. Another nice pattern that I like to use is called a fake out. So if we have, let's say, some consolidation on this side, and then I've got a matching candlestick coming back down, right? So that zone, we see the two candlesticks that match each other, and it comes back down into that zone, pushing further lower. Another nice one that I like to use is I like to call it a 3-wick, or whatever you want to call it, doesn't really matter. But we have candles that look like this, okay? So we've got these 3 wicks to the upside, kind of creating this sort of triangle structure to the upside, and that also for me is another confirmation. So I'm looking for these candlestick confirmations wherever my entries will generally be. So if I'm at this resistance, obviously if I get that structure over there, entries will go over there, stop losses, above my levels, and then take profits, wherever the next resistance is. But that's kind of what I'm looking for. So I'm going to write down what candlestick confirmations I want to see. Obviously, you can experience with them a bit if you are, still building your strategy. Experience with different candlestick confirmation patterns, whether they be wick rejections, engulfing candle structures, or anything along the lines of that. Experiment with them a bit. See which ones work the best. Get a name for them so you can remember what sort of structure it is, okay? And then you can just write them down. Now, another important one for day trading, not so much for swing trading, is a specific time you're going to be trading. Okay, so what time is it that you are trading? Now, for swing traders, this is also true to a bit, because it kind of puts you in a routine. A routine is always good for anyone who's looking to do anything successful, is to have a good routine. For me, generally speaking, I have in the mornings when I wake up, I don't usually I do my thing, just get my day ready or whatever I do, and then after, let's say 12 o'clock here in New Zealand, because we have rollover, I would then sit in the markets for a bit, look at the charts, see what it looks like. I'll probably sit there for an hour or so, just to kind of get into the zone of it, kind of understand where the markets are, where my zones and my levels are. So I'm always kind of involved in the market as a swing trader. And then at the end of the day, I'd go back home. I would sit in front of the computer. Maybe I'll start at about 5 p.m.-ish here, and maybe finish at like 6 or 7 is usually when my trading does generally finish. And most of the time when I sit at the computer is just to kind of watch the market, because I do rather enjoy. And that's very important as well, guys. If you're a trader, you need to enjoy watching the market and seeing how it moves. If it's going to be something you don't want to do and something tedious, you end up taking stupid trades because you just don't want to be there. So really, guys, you have to build a passion in trading, okay? And it's not a thing that you get born with. It's something you can obviously work on if you get into it. Just get into the habit of learning more and getting to the habit of start to like what you're seeing on the charts and get excited about the market structures and how they play out. Okay, so time-wise for day traders as well. Now, obviously, as day traders, there are certain zones we want to be trading in. Okay, the main zones, I would say, don't really trade the Sydney zone, which is in Australia, because that's right over the rollover period. So that's when settlement rates get get settled, obviously. So we'll see our spreads go extremely high. That's when the interest rate kind of kicks in. So the rollover interest rate is, is the interest for holding a position overnight. That gets kicked in. It was just called a swap in Forex. Okay, so that gets kicked in at this time during the Australian session. So I would say don't really trade the Sydney session. It's not really a good one to trade. There's not a lot of volume in it. Australia's market isn't actually that big. So the markets we'll be focusing on, personally, I would say, would be anything from the Tokyo session, which is our Asian market session. Okay, then we have our London or our European session. So the London market, and then obviously the big one, which is the New York session. Okay, So the one thing is, for me, obviously, I can't really trade too much into the New York session because I don't want to be sitting in front of the computer. I'm also not a day trader, but if I was a day trader, you know, the New York session is about, depending on daylight savings, can be here at 2 or 3 in the morning here in New Zealand, and it's not really where I want to be. All right, I want to be asleep at that time of the day. Okay, so another thing as well, guys, if you're a day trader, you're not going to be trading this entire session. Okay, so you can usually find, I would say, if you can, try and trade in between either the open and the switch over to that session. So maybe the switch over from London, the crossover from London to New York, or the crossover from the Tokyo to the London session. Okay, so those are some pretty good times to be trading. Now, generally speaking, as a day trader, you usually want to be only trading maybe 1 or 2 hours at a day. Okay, so what I'm saying that is, now when you do your test, obviously trade as much as you need or as much as you want, but chart down the time frame that you traded and made the most money, and you lost the most money, and obviously you broke even. So when you can figure out what time of the day you make the most money, what time of the day you lose money, obviously you can remove that, same as we do with the pairs and the signals and the entries. You can remove the time that you don't make money and keep the time where you do make money. Okay, this is going to help us to spend less time in front of the charts and be as efficient as possible, which is why we want to be traders, right? We don't want to be working 9-10 hours a day. We just don't want to do it. We want to spend maybe 2 to 3 hours a day, maybe 4 hours a day in front of the computer, and that's it. And that's the whole reason, obviously, why we want to get into trading, right? It's that financial freedom to be able to give you the time to enjoy life's bounties. Okay, so time is a very, very important one. And now the other one is, obviously, we want to record how many losses we've taken, okay, and how many wins we've taken. Okay, so the one thing with this is, once we've run through this, usually saying we want to do at least 2 or 3 tests. Okay, so the first 2 or 3 tests will be focusing on this. Actually, the first test, right? The first test will be focusing on this, the pairs, the entries, the confirmations, and the time you'll be trading. Okay, now once you've done that, the second test and the third test as well will be focusing on wins and losses. So the second test, mainly, the reason why we focus on wins and losses is so we can figure out how accurate we are. So we already know when is the best time to trade, what is the best to trade, and what pairs are the best to trade. Okay, so we figure that out. Now we need to see how accurate we are. And the reason for that being is we need to figure out how good our risk, our accuracy, so we can figure out how, what risk reward we can use. Okay, so this is going to be helping us with our wins and losses. Now let's say you make, personally for me, I'm a swing trader, so swing traders tend to see a little bit lower accuracy. So I'm sitting here at about 48% accuracy. Okay, a little bit higher than 48%, but I'm sitting at about 48% accuracy. So your second test will try and figure out how accurate you are. So I would say when you do take a trade, stick to, especially if you're swing trading, stick to a 2-to-1 risk reward ratio or a 3-to-1 risk reward ratio. You can go higher if you want. Just write it down to say, yes, the trader has reached the 5-to-1. As a day trader, I would say 1-to-1 or 2-to-1. If you want to do 3-to-1, that's fine. Generally speaking, as a day trader, the 3-to-1 risk reward ratios don't always get reached. So you're more likely to see a quick burst in the market, reach your 1-to-1 or your 2-to-1, and then get out of that position completely. Okay, so this is why we see accuracy in day traders tend to be a bit higher, but obviously, for me, it's a bit more stressful, and I don't like day trading that much. Okay, so once we figure out our accuracy, now we can say, okay, well, if you have accuracy setting roughly about 50%, you need at least a 2-to-1 risk reward ratio to take that trade. Okay, so we know this for a fact. Okay, so I set it about 3-to-1 risk reward ratio at least for my trades. This is where I have to set a minimum for my trades. I don't go anything lower than that. If I do go lower, I might do like a 2.9 or 2.8 depending, but generally speaking, I want to try go as high as I possibly can above 3-to-1 or sitting on 3-to-1. Okay, now obviously if you have a higher accuracy, if you're sitting at 60, 70, 80% accuracy, you can bring down your risk reward ratio. But guys, the one thing I would say, I would never have a risk that is higher than my reward. Okay, this is a path for bad trading, because if you lose, let's say you have a bad week or a bad month, right, those big losses compared to your small wins will start to deplete your account and completely destroy your trading. So personally saying, especially if you're a day trader, have at least a 1-to-1, if not a little bit higher than a 1-to-1 risk reward ratio. This is to ensure that when you lose, you don't lose as much as you win. Okay. This will make it a bit easier. So if you do have those bad weeks or bad months, which will come, guys, I can guarantee you, I've been trading for 6-7 years. You will have bad months, you will have bad weeks, sometimes 2 months which the market just does not want to give you anything. Right now, for me personally, for swing trading, there's not been really any good swing moves. So I have been doing a lot of break-even trades recently, which is fine. You know, I'm there to manage my trades. But journaling, guys, that's kind of how we want to run the journaling. And that's how we use that to our advantage and to improve our trading, guys. So if there's something you didn't understand, please let us know down below in the comments. Something specific, whether you say like whether it want to be the test, how can I do this test more accurately, let us know down below in the comments. Don't just say I don't understand. Let us know exactly what you don't understand. We'll be happy to, you know, broaden more, expand more on that topic. Okay, guys, thanks so much for watching. From us here at BlackBull Markets, guys, if you did like this video, smash the like button, subscribe to the channel, and as always, stay tuned, trade safe.